Chapter 10, Valuation and Rates of Return. Chapter 10, Outline. Valuation. Concepts in relation with financing and investment decisions. Valuation, price, yield of bonds, preferred stock, common stock. Valuation using the price-earnings ratio. Summary and conclusions. Learning objectives. Describe. Describe the valuation of a financial asset as based on the present value of future cash flows. Propose. Propose that the required rate of return in valuing an asset is based on the risk involved. Assess. Assess the current value price of bonds, preferred shares, perpetuals, and common shares based on the future benefits, cash flows. Learning objectives. Evaluate. Evaluate the yields on financial claims based on the relationship between current price and future expected cash flows. Describe. Describe the use of a price-earnings ratio to determine value. Figure 10-1. The relationship between time value of money, required return, cost of financing, and investment decisions. Chapter 9, Time Value of Money Concepts. Chapter 10, Required Rates of Return by Investors, Valuation. Chapter 11, Cost of Financing to the Firm. Chapters 12 and 13, Analysis of Projects based on Cost of Financing to the Firm. Valuation Concepts. A financial asset, security, is a claim against a firm, government, or individual for future expected cash flows. Examples of financial assets are bonds, preferred stocks, and common stocks. Valuation of a financial asset is to determine the present value of those future anticipated cash flows using an appropriate discount rate. Valuation concepts yield. An investment decision should be made by comparing the price or market value of a financial asset to its present value, determining the discount rate that equates the market value of a financial asset with the present value of its future expected cash flows. The discount rate is the market-determined required rate of return, ROR, or yield. Valuation. Concepts in relation with financing and investing decisions. Financial assets are issued by firms to attract funds from investors. Therefore, the required or expected rate of return or yield on these financial assets is the cost of financing for issuing firms. In turn, the issuing firm must earn at least this rate of return on its projects, the capital budgeting decision, in order to add value to shareholders' wealth. Yield. The real rate of return represents the opportunity cost of the investment. In the early 1990s, 5 to 7%, but now about 2 to 3%. Inflation premium. A premium to compensate for the effects of inflation. Since 2000, slightly less than 2%. Risk premium. A premium associated with business and financial risk, default, liquidity, and maturity risk, typically 2 to 6%. The required rate of return. The required rate of return equals real rate of return plus inflation premium plus risk premium. Example of a required rate of return. Real rate of return 3%. Plus inflation premium 4% equals risk-free rate 7% plus risk premium 3% equals required rate of return 10%. Valuation of financial assets. Valuation of a financial asset is based on determining present value of future cash flows. Required rate of return, discount rate, depends on market's perceived level of risk associated with individual security. Also, competitively determined among companies seeking financial capital. Implies investors willing to accept low return for low risk and vice versa. Previous efficient use of capital results in lower required rate of return for investors. Valuation of bonds. Calculating the value of a bond. Cash flows discounted at Y, the yield to maturity. Value of Y determined in bond market. Bond price is the NPV, net present value, of bond cash flows. Present value of interest payments plus present value of principal paid at maturity equals price of bond. Valuation of bonds formula method. We will not be using the formula method. Valuation of bonds formula method example. We can just skip this. We're not using the formula method. Valuation of bonds calculator method. So we'll skip this one too because we're actually going to do the Excel method. Valuation of bonds MS Excel method. We can calculate the present value, or we can calculate the price of a bond with MS Excel using one of these functions. PV, rate, N per, payment, future value, type, guess. Variables in round brackets. Rate equals the rate of interest. N per, the total number of periods. Payment, the value of any payments made. FV, the future value of the lease. Variables in square brackets may be left blank. Type equals the type of payment made, either type 0, end of period, or type 1, beginning of period. Guess equals, if you wish, you can guess the rate. Valuation of bonds, MS Excel method example. Let's look at the same bond with a face value of $1,000, paying 10% annual interest over 20 years, yielding 10%. Rate 10, N per 20, payment minus 100, future value minus 1,000. Changing the yield to maturity and the impact on bond valuation. Assume inflation premium goes up from 4 to 6%. Everything else constant. Real rate of return 3%. Inflation premium 6. Risk-free rate 9%. Plus risk premium 3% equals required rate of return 12%. How would this change the price of our bond? Valuation of bonds, not the formula method or the calculator method. Let's use Excel method. Rate 12%, number of payments 20, payment amount minus 100, future value minus 1,000. So the present value equals 850.61. Relationship between bond prices and yields. Bond prices are inversely related to bond yields. If yields decrease, the price of bonds increase. If yields increase, the price of bonds decrease. Distinguish between the bond yield and the coupon rate, which equals coupon par value. As interest rates in the economy change, the price or value of a bond changes. Table 10-1. Bond price sensitivity to yield to maturity. Maturities between 2 to 25%. Bond prices from $2,308.11 to $406.92. These are 10% interest payment, so that's the stated rate, 20 years to maturity bonds. Time to maturity. Time to maturity influences impact of change in yield to maturity on valuation. Longer maturity means greater impact of change in yield. Amount or premium above par value reduced as number of years to maturity decreases. Amount or discount below par value reduced with progressively fewer years to maturity. Effect of time to maturity on bond price sensitivity. Table 10-2. Bond price sensitivity to time to maturity changes. Time period in years of 10% coupon bond. Bond price with 8% yield to maturity. Bond price with 12% yield to maturity. From 0 to 30 time periods. Figure 10-2. Relationship between time to maturity and bond price. The relationship in the graph is not symmetrical in nature. Finance and action, the ups and downs of bond prices. Bond quotes are expressed as follows. The issuer, for example, Canada, coupon rate, that's the stated rate of interest, 2.75%. Maturity date, that's the date that the bond matures, December 1st, 2048. The price is 126.066, so that's above par. So everything at 100 is at par. Anything above that is above par, or it's a premium. And anything below that is below par, or a discount. Yield, 1.63%. That's the market rate. And the yield change is 1.627. The price is expressed as a percentage of maturity value of 1,000, due December 1st, 2048, or as value per 100 of maturity value. The coupon rate is annual interest, $27.50, calculated on the maturity value that the issuer is obligated to pay, usually every 6 months, $13.75. The yield is the current expected return. Determining yield to maturity from the bond price. Here we are trying to find the yield to maturity, Y, that will equate interest payments and principal payments to price of bond. Easiest methods to find the yield on a bond are financial calculator or Excel. Determining yield calculator method. We're actually going to use the Excel method. Let's look at a bond with a face value of $1,000 paying 11% annual interest over 20 years. If the price is $932.89, what is the yield? The present value is $932.89. The number of payments are 15. The payment, so that's the interest, is 1,000 times 11%, so it's 110. And the future value or face value is 1,000. Semi-annual interest and bond prices. Most bonds in Canada and the United States pay interest semi-annually. To make the conversion from an annual to semi-annual analysis, we follow 3 steps. 1. Divide the annual interest coupon rate by 2. 2. Multiply the number of years by 2. 3. Divide the annual yield to maturity by 2. Valuation of bonds calculator method, example 3. And we can just do that in Excel. Valuation of preferred stock. Preferred stock represents perpetuity, having no maturity date. Fixed dividend payment carrying a higher order of precedence than common stock dividends. No binding contractual obligation of interest on debt. Does not have ownership privilege of common stock, legal provisions that could be enforced on debt. Valuation of preferred stock. Cash flows from a preferred stock where P is the price of preferred stock, D is the annual dividend for preferred stock, and it's constant. K is the required rate of return, which is the discount rate. Valuation of preferred stock. Generally, preferred stock is a perpetuity, so it goes on to infinity. The price P of preferred stock will then use the formula for the present value of a perpetuity of constant dividends at the discount rate. P equals D divided by K. Valuation of preferred stock example. Assuming $10 annual dividend and stockholder requires 10% rate of return, price of the preferred stock is P equals D divided by K. $10 divided by 10% equals 100. Increased required rate of return. If the required rate of return of investors increased to 12%, the price would change to P equals D divided by K equals $10 divided by 12% equals 833.33. Decreased required rate of return. If the required rate of return of investors increased to 8%, the price would change to P equals D divided by K equals $10 divided by 8% equals $125. Determining the required rate of return yield from the market price preferred. P equals D divided by K. reverse the position of P and K. K equals D divided by P. Assuming the annual preferred dividend is $10 and the price of the preferred stock is 100, the required rate of return yield is K equals D divided by P equals $10 divided by $100 equals 10%. A higher market price provides quite a decline in the yield. K equals D divided by P, 10 divided by $130 equals 7.69%. Valuation of common stock. Investors place value on common shares based on the firm's ability to generate cash flow or earnings. Therefore, a share of common stock can be valued based on the present value of A, expected stream of future dividends, dividend valuation model, B, expected future earnings, price earnings model. Dividend model, generally applied with modifications to 3 different situations. 1, no growth in dividends. It's valued like a preferred stock. 2, constant growth in dividends. And 3, variable growth in dividends, Appendix 10B. So we won't be worrying about variable growth. Yield, rate of return, reflects the dividend yield on the stock and the expected growth rate in the dividend. Dividend model cash flows. Generally, preferred stock is a perpetuity, where P equals price of common stock today, D equals dividend for each year, K equals required rate of return for common stock. Dividend model, no growth in dividend. Common stock pays constant dividend as in preferred stock. No growth policy does not have much appeal for investors. P equals D divided by K. Price of common stock today is P. D is current annual common stock dividend at end of year. And K equals required rate of return for common stock. Assuming a dividend of $1.87 and required return of 12%, P equals 1.87 divided by 12% equals $15.58. Dividend model, constant growth in dividend. General valuation process where P equals price of common stock today, D1 equals dividend in year 1, D2 equals dividend in year 2, and so on. G equals constant growth rate in dividends, and K equals required rate of return for common stock, the discount rate. Dividend model, constant growth and dividend formula. The formula shown can be modified to a simple form if 1, the firm has a constant dividend growth rate, and 2, the discount rate exceeds the growth rate. P equals price of the stock today, D equals dividend at the end of the first year, K equals required rate of return, or the discount rate, and G equals constant growth rate and dividends. So P equals D divided by K minus G. Assuming a dividend of $2, a required return of 12%, and a growth rate of 7%, price of stock is P equals $2 divided by 12% minus 7% equals $40. Determining the inputs for the dividend valuation model. Dividends, annual reports or investment websites. The required rate of return can be estimated using the capital asset pricing model examined in Appendix 11A, which we won't be doing, or by using the current yield for long-term Government of Canada bond and a risk premium based on the level of risk of the common shares. The growth rate, G, best estimated from the historical growth rate and dividends projected in the future. G can be estimated from the growth in earnings per share, revenues per share, or cash flow per share if one or the other of these items are not available. Common stock valuation model based on future stock value. To know present value of investment, assume stock held for 3 years then sold. Adding present value of 3 years of dividends and present value of stock price after 3 years gives present value of benefits. The appropriate formula is P equals D divided by K minus G. Determining the required rate of return yield from the market price, common. P equals D divided by K minus G, reverse P and K. K equals D divided by P plus G. Assuming the price of the preferred stock is $40, the annual preferred dividend is $2, and growing at a constant rate of 7%, the required rate of return is K equals $2 divided by $40 plus 7% equals 5% plus 7% equals 12%. The price-earnings ratio concept and valuation. The price-earnings ratio represents a multiplier applied to current earnings to determine the value of a share of stock in the market. The PE ratio is influenced by the earnings and sales growth of the firm, the risk or volatility in performance, the debt-equity structure of the firm, the dividend policy, the quality of management, other factors. Table 10-3, an example of stock quotations, January 2020. Royal Bank and Descartes, I think that's how you say it, I have no idea. Open, high, low, close, year end, year low, volume, earnings per share. High versus low price earnings. A stock with a high PE ratio indicates positive expectations for the future of the company, means the stock is more expensive relative to earnings, typically represents a successful and fast-growing company, is called a growth stock. A stock with a low PE ratio indicates negative expectations for the future of the company, may suggest that the stock is a better value or buy, is called a value stock. Variable growth in dividends. Most common finance literature assumes common share valuation with no growth or constant growth in dividends. When the firm experiences very rapid growth, it is called supernormal growth. Appendix 10b discusses the valuation of a supernormal growth firm, and we won't have to worry about that. Summary and conclusions. Valuation of financial assets, bonds, preferred stock, and common stock is determining the present value of future cash flows. The discount rate used in the valuation process is called the rate of return or yield to maturity. The yield, ROR, is composed of a real rate of return, an inflation premium, and a risk premium. Summary and conclusions, part 2. The price or current value of a bond is equal to the present value of interest or coupon payments over the life of the bond plus the present value of the principal payment at maturity. The discount rate used is the yield to maturity. The value of preferred stock is the present value of an infinite stream of level dividend payments. Summary and conclusions, part 3. In general, the value of common stock is also the present value of an expected stream of future dividends. However, there are 3 possible scenarios. The price-earnings ratio is an easy rule of thumb used to determine the value of a common stock. Appendix 10b, variable growth and dividends. We're actually not covering this in this class.